Hello and welcome back. Today we're going to talk about the efficient market hypothesis. So on the agenda, as I said, we're going to talk about the efficient market hypothesis, and in particular we're going to give some examples from Sweden on the weak form, the semi-strong form and the strong form. And hopefully these examples will help you understand what is meant by the perhaps rather abstract term of an efficient market. So the idea here is probably there are quite a few who would like to make money in the stock market if you could. So I've taken an example of a fairly volatile stock which moved up and down a lot just to show how it could be done. Okay, so for example, at this point of time here, if I knew that something was going to happen in Fingerprint Cards, then I would probably purchase quite a lot of stocks because I see that the price went up a lot up to here, and then somewhere here I would like to sell it again, wait until it went down, buy again here, sell it at a new high, buy low, sell high, and keep going like this. And if I could do this, then I would make a lot of money, at least if I had a lot of money from the beginning. But I would get a very high return because this is only this is a little bit more than a year. No, so a little bit less than a year that all of these movements have been. So I could have get a very good annual return if I could foresee when this happened. And the efficient market hypothesis, or the notion of an efficient market, basically means that I should not be able to predict this, at least not without some kind of superior information that I'm not allowed to use. So what the efficient market hypothesis states is that prices, a stock price, should reflect all available information. And that means that the information that everyone have access to is already interpreted correctly, or as good as possible at least, and the price reflects that information. So I should not be able to use information to gain a superior return. But the question is, what do we actually mean by all available information? I mean, you could say that the CEO of a company obviously must know more about it than me, even if I spend years studying it. Okay, maybe not years, depends if I work on it or not. But the CEO should have information that I don't. Is that then all available information or not, or how would you count that? And that's where the different forms come into play. So we start with the weak form, and we take a quote from Warren Buffett, which says that if past history was all there was to the game, the richest people in the world would be librarians. And the idea there is, of course, that the ones with most access to the past are the ones who have access to books, that is, librarians. And the weak form of the efficient market hypothesis states that you cannot use past information, or at least past data, price data, in order to gain any abnormal profits. So the available information in the weak form means that all past market trading data is already incorporated in the price. So by studying a chart, for example, I cannot find out when it's a profitable moment to buy and when I should sell. So I think we should just take a sequence to look at the price of Fingerprint Cards, and then you can try, without going back to the last picture, to predict when you should sell and when you should buy. And it's probably not that easy. Okay, so we start here. And now if we don't remember anything at all, I would say that, yeah, it looks like this company had a quite good increase in the last months. It's gone from somewhere around maybe 7-8 crowns up to now around 30. So that's a very solid increase, and maybe this is enough. I mean, come on, it's increased by 200-300% already, so probably it should go back. Yeah, well, then something happened here, and it went up a lot. And I'm not really sure how I would see that in the past history, that it would go up by this amount. I probably wouldn't. But then we can look here again. What is going to happen now? Well, I don't know. Maybe it's falling down again. Maybe this was an overreaction. Or maybe this is just a short setback. So in a moment, it's actually going to bounce back and continue its way upwards. So we have that direction that it could go. Or it could go down again. Or it could level out here so that this is actually the new price it should be on. So if we continue, we see that it kept going down a little bit. And now again, the question is it going to go up? Is it going to stay here? Or is it going to fall back down? Well, in this case, it kept going down. And we can continue this sequence to see that it's very, very hard to predict just from the past history where the stock is actually going. And if I do find a way to do this, I might make a lot of money on it, or I will teach it to you so you will make a lot of money on it. But I don't know anyone who have actually managed to do this for a long time at least. But studying past data is something referred to as technical analysis, and the weak form of the efficient market hypothesis states that you cannot analyze this past data in order to find out when you should buy and when you should sell and make a profit on it, in the long run at least. Okay, the semi-strong form instead is a little bit wider in the information set. It says that all publicly available information should be incorporated in the price, or is incorporated in the price. So what does that mean then? Well, it means that even if I would look into annual reports and quarterly statements and that kind of information is available, but also news, maybe I can look at commercials, and so to try to predict what's going to happen for the company, that will not help, because there is already someone else who has done it, interpreted it, and purchased the stock or sold it until the price got to the new level where it should be, given the information we have today. So, for example, this is a little bit less than a month history, and we can see here that something happened in this day. And then one could wonder, is such a huge increase motivated, or why did it happen? Okay, so it turns out that around here, Alfa Laval gave out a quarterly report, which was actually quite strong. It beat the market expectations. And based on that report, the stock went up by 4.6%. So it wasn't just a coincidence that this day was a good day. It was actually that they delivered some news, which were good news. And because they were good news, they were incorporated into the price, give a higher price today. So this could be seen as how the market reacts to information. So if it's good information, then the price will usually increase. And there's nothing weird about that. It just means that we didn't know about this quarterly report, the good performance, until it was announced. And also, we will talk a little bit about Alfa as a measurement, a performance measurement. Of course, it has nothing to do with the company Alfa Laval, in case there's any confusion. We can also look at Axfood, which has a very similar graph. And we see again one day here, which appears to be rather abnormal. But if you look into the news to see what happened that date, you will see that they also delivered a strong quarterly report where they beat the market expectations. And they even had a stronger response. They increased the price by 7.9% here. So again, the market reacted, and they reacted quite fast to the good news by setting a new price in the market. And if we would look at more detailed data, like minutes or seconds, we would see that this information would be incorporated very quickly. So if I want to use this information, I would have to be extremely fast. And that is also something concerned with the semi-strong form. It says that it shouldn't take time for this information to get into the price, because in a moment, this information is already available and it's in the past, so it should be incorporated in the price. Otherwise, the market is not efficient. But as it turns out, usually information is incorporated quite fast. The question is rather, is it all of it incorporated, or do you maybe overreact or underreact? But we can take another example where we have the SAS stock. And here maybe it's a little bit harder to see, but in this day they had a quite substantial downturn. They have been falling now for a while, but here they had a very substantial decrease. And if you look at the news, it turns out that they also delivered a quarterly report which did not live up to the market expectations. So not only when the information is good do the market react, but also the opposite, of course. If you deliver a bad report, then the price will decrease. And in this case, they had a decrease of minus 7.3%. So in all of these three cases, the biggest movement in this month was due to some information that was either good in the first two cases or bad in the case of SAS. And the semi-strong form says that it should react to news that are actually relevant or unexpected. In the strong form, then you say that all available information should be incorporated in the price. And that's including private information that held by insiders, such as the CEO or the board. And what that means is basically that if I would have a private moment with the CEO of SAS the day before the announcement of the report, and he would tell me that, okay, we're going to deliver a very bad report tomorrow, so maybe you should sell your stocks. And I would sell my stocks, I would not gain on that, because that would already be incorporated in the price. And probably that's not true. As we can see here, if I did knew, I mean, the CEO must have known that the report was actually worse than the market expectations. So if he told me at this point and I sold, then I would not have to take this loss on the day of the announcement. But of course, then the CEO would break the law, because he's not allowed to tell someone information that is relevant for the price if he doesn't give it to all of us at the same time. But the strong form, you should not say semi-strong, you should say the strong form. In the strong form, we say that even that type of information is incorporated in the price, and therefore I should not be able to use it to gain any extra money above what might be expected given the risk I take. Okay, so that's on the efficient market hypothesis. I hope that these examples help. Thank you.